Hi everyone. We will now be looking at practice problem 1318A is on page 636 of your book to take a look at how we complete financial statement analysis, which of course is what our chapter is focused on. So we have Paul Sabin organized Sabin Electronics 10 years ago to produce and sell electronic devices on which he had secured patents. Although the company has been fairly profitable, it is now experiencing a severe cash shortage. For this reason, he is requesting a $500,000 long-term loan from the bank, $100,000 of which will be used to bolster the cash account, and $400,000 will be used to modernize the equipment. The company's financial statements for the two most recent years follow. So you can see there we have their balance sheet and their income statement. During the past year, the company introduced several new product lines and raised the selling prices on a number of old product lines in order to improve its profit margin. The company also hired a new sales manager who had expanded sales into several new territories. Sales terms are 210 net 30, all sales are on account. To assist in approaching the bank about the loan, Paul has asked you to compute the following ratios for both this year and last year. So let's take a look. As you saw and heard on the video about financial statement analysis, what you were presented with and learned and probably have seen in past classes are the tools that we use as analysts to determine the health of a company, the financial health. And you know, some of my students kid around. I go, we're like the doctors, the financial doctors. And it's the truth. When you want to know how healthy you are physically, your body's healthy, or mentally, you go to a doctor. They use tools. They look at norms for your age and other criteria, and then they assess your health based on tools they use. We do the same thing as financial doctors, but we are now looking at the financial health of a company. So this chapter presents you with the tools that we use in doing the financial health analysis. The first one being working capital, and that's where we take current assets minus current liabilities. So what this tells us is dollar-wise how much in current assets we'll have once we pay current liabilities. And what you have to remember, going back to your financial accounting days, is that a current asset is an asset that's available to be used in the coming year. Current liability is a liability we got to pay in the coming year. So that's why we focus on these two items. So working capital, or the excess assets that will be available, 720. Last year they were 660, so they improved. The next ratio is the current ratio. And that's found by taking your total current assets from your balance sheet and dividing it by the total current liabilities. So we do that for each year. The current ratio for this year is 1.9, where it was 2.53 last year. Now, what does this tell us? Well, you could look at it this way. For every dollar the company owes in current liabilities in the coming year, they have $1.90 of current assets to pay them. Last year, they had $2.53 in current assets to pay $1 in current liabilities. Now, so they can cover their current liabilities, but our health here compared to last year has grown weaker financially. It doesn't mean we're bad. It's changed and it's weaker than we were last year. It's kind of like saying, you know, your blood pressure is a little lower than it was last year or higher than it was last year. Okay, so that's just showing us that. The next ratio is called the quick ratio or acid test ratio. And what we do is, it's very similar to the current ratio, but instead of using all of the current assets, we use the most liquid, financially liquid assets, those that can be converted to cash very, very quickly, within 30 days. So your common assets will be cash, because it's already in cash form, marketable securities, because you could sell them on the market very quickly, accounts receivable, okay? And that's it. The other assets are not considered to be converted to cash very quickly. So in our this year calculation, we have 550,000 of very liquid assets to pay our current liabilities. So we divide the current liabilities into that amount, 69 cents. So for every dollar of current liabilities this year, we have 69 cents of liquid assets, near cash or close to cash assets. When we do the same computation from last year, the 150 in cash plus the 18,000 in marketable securities plus the 300,000 in accounts receivable, divide that by last year's current liabilities, it was a 1.09. So we had 1.09 in liquid assets to pay current liabilities. Another way people look at this is they'll say, if all of the current liabilities became due, how much immediately, all of them at once, would we have enough in those liquid assets to pay them? And the answer would be no for this year. Last year, yes. So we became a little bit financially weaker with regards to this ratio. That's all we're saying here. The next ratio is the average collection period. Now, the average collection period is found by really a two-step process. We first determine what we call accounts receivable turnover. And we do that by taking our credit sales, which they tell us in the problem we're all on account, and that's off your income statement, and divide that by your average accounts receivables for the year. Now, average accounts receivables would be this year's accounts receivables plus last year's accounts receivables. So 300 plus 480 divided by 2. So 390,000 for this year's calculation. So we get 12.8 when we divide the average receivables into sales on account. We do the same calculation for last year to determine last year's accounts receivable turnover. Last year's sales were 4,350,000. The beginning of the year's accounts receivables, they tell us in Part D, were 250,000. Add them to the end of last year's accounts receivables, 300,000, and divide by 2. So you get 275,000 as the average. Divide the average receivables into sales, 15.8. So just that ratio, here's what it means. It's the number of times per year, on average, the company collects its accounts receivables. So last year, we collected them 15.8 times on average. This year, 12.8. So we're slowing down on receiving money from our customers. Now, if we want, and we should, we want to determine, well, what's the average time it takes us to collect our money? Take 365 days, representing an entire year, divided by the number of times per year you collect your money, which is accounts receivable turnover. It takes about 28 and a half days for us to collect the money from the day of the sale to ultimately receiving the money from the customer. Last year's computation would have been the 365 days divided by 15.8, so 23.1 days. So we're collecting our money a little longer out there. It's taking us 5 extra days now to collect our money as compared to last year. So that is a weaker financial situation. The next calculation is inventory turnover. So the accounts receivable, Part D, tells us how well we manage our accounts receivables. And obviously, we're having some issues there. This tells us how well we're managing our inventory. So we calculate first our inventory turnover ratio by taking cost of goods sold from this year's income statement and dividing it by our average inventory balance, which would be the end of last year's inventory of 600,000 plus this year's ending inventory of 950 right off of our balance sheet, 950,000, and divide that by 2. So average inventory would be 775,000 this year. Divide that into our cost of goods sold from this year. Inventory turnover is 5 for this year. Do the same computation for last year, but use last year's numbers. Cost of goods sold last year was $3,450,000. The average inventory would be found by taking the beginning of last year's inventory given in Part E of $500,000 plus $600,000 end of the, last year's inventory divided by 2, $550,000. So once you complete the operation there, inventory turnover last year was 6.3. So this tells us how many times per year we sell out our inventory on average, or how many times, if you want to look at it from this perspective, we have to replace it a year. So this year we replaced it or sold it out 5 times. Last year, 6.3. If we want to see how many days it normally takes us to sell the inventory, well, take 365 days divided by the number of times you have to replace the inventory. It's 5 times this year. So from the day of purchase to the day of sale, 73 days pass this year. Last year's was 365 divided by the 6.3 inventory turnover, 57.9 days. So we're slowing down. It's taking us almost 14, 15 extra days to sell our inventory. It's not good. Remember, that's how we make our money. We want to get it in and get it out as quick as possible. So our operating cycle would be our average sale period plus our average collection period, 100.5 days compared to last year, 81 days, which that has decreased as well. Okay, so, well, it's increased, I should say. So it takes us longer overall to collect and sell. From the day we buy stuff to the day we get our money back from the sale, it takes 101.5 days this year. Last year, 81 days. From the day we bought our inventory to the day we got the cash from the sale of that inventory. That's 20 days, not good. G, the total asset turnover would be found by taking sales for the year divided by your average total assets, which would be total assets this year plus total assets from the beginning of this year, $2,460,000 divided by 2. So the average assets are $2,730,000. We divide that into the sales of $5 million, 1.83. So dollar-wise, we earn for every dollar in our assets, $1.83 in sales. Last year's number, doing the same type of computation, $1.78. So it's how many times we are creating sales for our assets overall. The next ratio is the debt to equity ratio. We find that by taking our total liabilities for the year, 1.4, total liabilities divided by total stockholders' equity, 1.6. And it's basically showing the percentage of debt we own compared to equity. Okay, so 87.5%. Or 0.875. For every dollar in stockholders' equity, we have 88 cents in liabilities. Last year's was 72 cents, using the same numbers, but from last year. So we're borrowing more compared to our equity this year as last year. So there's more debt to equity this year than there was compared to last year. That signals a weaker financial situation. You want a higher, or you want your debt to equity ratio to be lower, if you could. This helps determine how well a company can pay on its liabilities overall. Another ratio that helps to determine, especially on long-term liabilities, is the times interest earned calculation. This is our next ratio, and we find it by taking our net income before interest and taxes. So if they're subtracted out, you got to add them back in. So our net operating income, which is the number essentially that would be net income, add back income taxes and interest expense, would be $472,000. Divide that by 72,000, the actual interest expense for the year. So this year, 6.6 times last year's number, we would have had 352,000. Our interest expense last year was 72,000 also, so it would have been 4.9. And that's just telling us how many times the company can pay interest from their earnings. And think about it. Where does the company get money to pay interest? Well, they've got to make money. So this is just showing, one, that the company could pay it at least once, but the more times they can pay it, the more likely they will pay it. So it looks like they improved on this side of the ability, their financial health. They're able to pay their interest more often, more times than last year. The equity multiplier is our final item, and we find that by taking our average total assets. Again, take total assets this year plus total assets the beginning of this year, divide by 2, and divide that by average stockholders' equity, which would be stockholders' equity this year, 1.6 million, plus the beginning of the year, 1,430,000, divided by 2. So you do that calculation for each year. Divide that, 1.8 this year, 1.71 last year. Just give me a second here. And what this tells us is the portion of assets that are financed by the stockholders. So for every dollar in assets, for every dollar in stockholders' equity, there's $1.80 in total assets. Okay.